Hey everyone, welcome back to the channel. Today we're breaking down something every beginner investor should know: dividends. If you've ever heard people talking about passive income or just getting paid for holding stocks, they're usually talking about dividends. By the end of this video, you'll know exactly what dividends are, why companies pay them, and how you can use them to build long-term wealth. A dividend is simply a payment that a company makes to its shareholders, basically a reward for owning their stock. Think of it like this: if you own a part of a company, you get to share in the profits. An example, let's say you own one share of Coca-Cola. If Coca-Cola decides to pay shareholders $1.84 per share in dividends this year, you'll get that $1.84 just for owning the stock. Some companies pay dividends quarterly, every 3 months, some annually, or some not at all. Companies that are profitable and stable often reward their investors through dividends. It's their way of saying, "Thanks for trusting us with your money." Big established companies like Johnson & Johnson, Procter & Gamble, and Apple all pay dividends. On the other hand, newer, faster-growing companies like Tesla or Amazon usually don't. They prefer to reinvest profits back into the growing business. So paying dividends signals to the investors, we're profitable, stable, and we don't need to reinvest every dollar. There are a few key dates to know. Number 1, declaration date, the day the company announces a dividend. Number 2, ex-dividend date, the cutoff date. You must own the stock before this date to get the dividend. Number 3, payment date, when the money actually shows up in your account. Dividends can be paid in cash, which is the most common, or in additional stock shares, and the money just gets deposited right into your brokerage account. You'll often hear the term dividend yield. This tells you how much a company pays in dividends compared to its stock price. Here's the formula: dividend yield equals annual dividend divided by the stock price. Here's an example: if Coca-Cola stock is $60 and it pays $1.80 in dividends per year, the yield is 3%. Dividends can be a steady income stream. Retirees love dividend-paying stocks for this reason. They can also be reinvested automatically through a DRIP, dividend reinvestment plan, where your dividends buy more shares of the stock. Over time, this creates compound growth, where your dividends buy more shares and those shares earn more dividend. Let's say you invest $1,000 in a stock with a 3% dividend yield. That's $30 per year. If you reinvest it, you buy more shares, which means your dividend grows the next year. Fast forward 20 years, and thanks to compounding, you could have thousands of dollars in extra value just from dividends. That's how long-term investors build wealth without constantly trading. Not every company keeps paying dividends forever. If profits drop, they might cut or stop dividends. Chasing only high dividend stocks can be risky. Always check the company's health first. Dividends are great, but they should be part of a balanced investing strategy. So to sum it up, dividends are cash payments from companies to shareholders. They're a sign of stability, they can be reinvested for long-term growth, and they're a powerful way to build wealth over time. If this video helped, make sure to hit the like and subscribe for more investing breakdowns. And let me know in the comments, do you prefer dividend-paying stocks or do you go for growth companies instead? Thanks for listening.